Welcome to the Deep Dive. We cut through the clutter to get you the core insights fast. Today we've got a clear mission. Extract the absolute best, most useful investment wisdom from the legends, specifically for navigating 2025. Our source material is the new Timeless and Timely. Greatest investment ideas and advice from Warren Buffett, Peter Lynch, Ray Dalio, and other masters, the 2025 edition.
Yeah, and this couldn't be more timely, really. You've got big shifts happening, leadership at Berkshire Hathaway, for instance. Plus, some traditionally safe defensive stocks are looking a bit shaky, and everyone's still talking about debt cycles. So revisiting these sort of foundational playbooks through a 2025 lens feels pretty crucial right now.
Okay, let's jump right in then. Warren Buffett. What are the absolute must-know principles from him that really matter for investors heading into 2025?
Well, Buffett's core ideas, they haven't really changed, and they're as vital as ever. Buying wonderful businesses at fair prices. That margin of safety is key. Holding for the very long term. And honestly, for most people, his advice still holds. A low-cost S&P 500 index fund is a great foundation.
Right. And how does that apply today? Because as you mentioned, some of those reliable defensive names have been struggling a bit.
Exactly. And Buffett himself has actually flagged potential issues, like warning about utilities maybe being overvalued because of climate change risks down the line. It really highlights his point for 2025. You have to understand the business quality. Is it durable? Is the value really there, especially with new risks emerging?
So boiling it down for you, the listener, what's the actionable takeaway from Buffett for your 2025 strategy?
I'd say it's about doing the homework. Look for companies with those strong competitive advantages, the wide moats he talks about. Find ones that are also growing their dividends consistently, and check if they're trading at, say, valuations below their historical averages, maybe using something like the EV/BIT median. But remember that index fund anchor. Individual stocks can maybe add something extra, but that core diversification is smart.
Okay, let's pivot to Peter Lynch, famous for invest in what you know. In this world of, complex AI stories and hype, does that simple idea still give you an edge?
Oh, absolutely. I'd argue it's more important now. There's so much noise, so many opaque business models, especially around AI. If you actually use a product, understand a service, see it gaining traction yourself, that's a real advantage. It cuts through the speculation. And he's also recently reminded everyone again, don't try to time the market. It's tempting when things are volatile, but it rarely works out.
So, practically speaking, how do you apply Lynch's what you know idea when building a portfolio for 2025? Any concrete steps?
Yeah, start with your own experience. Is there some AI software making your job easier? A new drug someone you know is benefiting from? That's your starting point. Then, dig into the fundamentals. Lynch likes strong earnings growth. Maybe look for over 20%. Keep an eye on debt to equity below 50% is a decent rule of thumb, and check the valuation relative to growth, the PEG ratio, maybe under 1.5. But crucially, Lynch always stressed holding on. Don't get shaken out by market swings. That's where the long-term gains are.
Moving on to Ray Dalio. His big things are diversification and understanding those big economic cycles, especially debt. How do his ideas help navigate 2025's uncertainties?
Dalio's concept of all-weather diversification, spreading your bets across assets that don't move together, is just critical right now. Think geopolitical risks, potential economic shifts. He talks about needing maybe 10 to 15 truly uncorrelated return streams. That's how you smooth out the ride and improve risk-adjusted returns. And his warnings about things like tariff risks, echoing the 1930s, well, that makes broad diversification seem even more essential as a buffer.
How can listeners, actually do that, implement that kind of Dalio diversification in their own portfolios?
It's about mixing things up intelligently. So maybe pair your core value stocks with, say, commodity trend following strategies, or a global macro fund. Short duration T-bills are another piece for stability and liquidity. The key idea is not letting any single risk dominate your portfolio. Try to keep exposure to things like the overall stock market direction or interest rate changes or credit risk, maybe below 20% each, something like that.
Okay, and then we have the wisdom from Charlie Munger, obviously, and other key voices like Howard Marks, Joel Greenblatt, John Bogle. What timeless lessons from them stand out right now?
Munger's influence is huge. Using mental models, flipping problems upside down to see risks inversion, he called it. Avoiding stupidity is often better than trying to be brilliant. And patience. Especially now with all the AI excitement, remembering to be patient is vital. Howard Marks emphasizes thinking in probabilities. The future isn't certain, so beware of strong convictions. Joel Greenblatt's magic formula, finding high return on capital companies at cheap earnings yields that still works. And John Bogle, Well, his case for low-cost indexing just keeps proving itself over time for most people, the common thread. Investing is part analysis, part temperament. You need both.
So when you look at all these legends together,
Yeah.
what are those recurring themes, the core ideas that pop up again and again that listeners should really integrate?
Yeah, a few big ones stand out. 1, think long-term, always. 2, understand what you own. Stay in your circle of competence. 3, focus relentlessly on price versus actual value, and remember how debt cycles affect that equation. 4, diversification is key, but smart diversification, whether it's Buffett's collection of businesses, Dalio's asset mix, or just broad index funds. And finally, maybe the most important, emotional control. Don't panic sell, don't get greedy, be patient, be opportunistic when others are fearful. That's huge.
Okay, so drawing on all that wisdom, what could a practical sort of 2025 ready investment blueprint look like for our listeners?
All right, here's one possible way to structure things. Maybe 50-60% in your core holdings. A low-cost, broad market index fund, perhaps alongside some high-quality, dividend-growing companies with wide moats. You might look for things like return on invested capital over 12%, free cash flow yield over 4% in those individual names. Then maybe an opportunity sleeve, 20-25%. This could be those Lynch-style know-it growth stocks with catalysts, or maybe some Greenblatt magic formula picks. For risk balancing, 15-20% in things that behave differently. Gold, TPS perhaps, a commodity trend ETF, maybe a global macro fund drawing from Dalio. And always keep some dry powder, 5-10% in short-term treasuries, ready for when good opportunities pop up unexpectedly. And critically, have a plan, an if-then playbook for market drops. Review regularly, but maybe only rebalance annually unless things get really out of whack, say, more than a 5% drift. That helps curb impulsive moves.
That's a really solid framework.
Okay, last practical bit. Give us a quick checklist, something listeners can run through before hitting buy on any investment in 2025.
Sure. 5 quick questions based on all this wisdom. 1, is this truly in my circle of competence? Do I get this business? 2, does it have durable economics? A real moat, recurring revenue? 3, is the price fair or better? Does a reasonable valuation suggest, say, an 8% plus potential return? 4, how does it fit my overall portfolio? Does it add diversification or just more of the same risk? And 5, the sleep at night test. Can I stomach a 30% drop without freaking out? The rule is simple. If you can't tick yes on all 5, the legends would tell you to just pass. Wait for a better pitch.
Incredibly useful. So wrapping up this deep dive into these investing giants, what's the single most important message for you, the listener, navigating 2025 and beyond?
It's that while markets change, headlines change, even leadership at iconic companies changes, the fundamental principles don't. Focusing on quality, understanding what you own, being disciplined about price, diversifying wisely, and mastering your own emotions, that's the enduring path to long-term compounding. Those principles are timeless and timely.
And a final thought to leave you with. Which specific principle from these legends resonates most with your approach right now, and why? And maybe more importantly, what's one new idea from today you could realistically add to your own investment strategy going forward? That concludes this deep dive.